there's no prohibition on you doing business for the DSCR loans. And
we could
those
do a
other
loan in
states.
Washington. I'm
Got
not
it.
licensed in Washington, but if it's a DSCR
Got
business
it.
purpose loan, we can do that.
You're just brokering it out.
We are still working on our 15th state that Emmanuel mentioned earlier is Massachusetts.
Okay.
That should be coming shortly. And I believe it's tomorrow morning or right now, we are closing a DSCR loan in Massachusetts.
That's awesome.
Yeah.
Get all your Bostonian snowbirds here.
Yeah.
How do you get these? How do you get these licenses? You sit for the exams?
So the twofold. So as owners, one of us has to be the guarantor for the state, and then so the company has to get licensed, and each individual loan officer that wants to do loans in that state would have to get licensed as well. So it's not really that difficult. It's a little bit of continuing education. Each state is different. Some of them have E&O policies you got to do. Some of them have bonds that we got to do. Some different things, application fees. It's a money grab more than anything else.
As you can imagine, none of the states talk to each other, and none of them want to standardize anything at all.
Yeah.
So there's almost no reciprocity between states.
There's no reciprocity.
And you can imagine certain states are more difficult. New York is almost impossible to do business in. Massachusetts, that we're just going in now, is also not an easy state, but we've got some branches up there that we're looking to recruit. So
it's worth it for you to do.
For us, yes.
Yeah. And you already have a bit of a presence up there in the Northeast, because I know you're from there, from that New Hampshire area, Maine area. And
we're licensed in Maine and New Hampshire and Connecticut, New Jersey. And so
Massachusetts is a natural fit. Yeah. That makes sense. That's good. Larry, what have you seen? Because you do a ton of business, a lot of deals. What have been the challenges that you've had with loan officers, other loan officers, of course, not Emmanuel and Jared and Choice Mortgage, but
never.
I know from a title company perspective, I do title, our title department. We do a lot of deals, especially dealing with some of the brick and mortars that I call them, the Bank of Americas, the Wells Fargo. They're atrocious. Sorry, anyone that works for them, but your back end departments are terrible, and they blow through deadlines and closing dates and financing contingencies, and it's really, really nightmarish when I see that come across my desk. That someone's using one of those big, what I call brick and mortar banks, but even other loan shops that are out there, they're not all made equal. What are some of the common challenges that you see, out there where that Jared or Emmanuel can talk to how they do things differently?
I think the biggest thing from a execution perspective on the lending side, from my perspective as a real estate broker, is anticipating or preparing the buyer in advance and communicating clearly in advance. So like getting ahead of any of the unforeseen issues or the potential issues that could come up, right? We talked about some earlier, like for the condos, as we talked about, there's a lot of condos in here in South Florida, do a lot of condo deals, represent a lot of sellers that are doing these condo deals. And again, usually when I'm representing the buyer, we're already ahead of it. So we don't have these issues. But on the listing side, it's really hard sometimes to get with the lender to confirm that they can even write the loan or do the loan for a specific condo building for a number of reasons that we can get into. And so that's a big thing that I end up dealing with. And Emmanuel and the Choice team has a good solution on how to kind of dodge that if you're a listing agent, which I think is great. You and I were just talking about that. You could dive into that here in a minute. And then also, like, I don't know, Wells Fargo and these other big banks. I think the biggest hurdle with them is the lack of clarity and communication just upfront and throughout the process to really understand, can you actually hit the targets that we've written in this contract, right? And are they anticipating unforeseen issues with the borrower? And are they actually underwriting the borrower in full upfront, right? I think that's another big one. I mean, that's a big one. And it's sometimes hard to know that answer as a listing agent. And I'm a licensed mortgage broker, and I can somewhat talk the talk, and I get on the phone with these brokers, mortgage brokers, lenders, whomever, that are representing the buyer when I'm representing the listing agent or the listing. And I can't always get the clarity that I'd like from that, even when I get them on the phone, if they pick up the phone. We'll start there, right? So yeah, maybe you can shed some light on just like the condo experience a little bit from your perspective, and how you can help borrowers, buyers agents, and listing agents.
Yeah, so a couple things there. So to one of your points about we had made a business decision a long time ago, which at the time was, felt revolutionary. Felt like the world was ending when we had decided to stop pulling credit on buyers until they send us all their documents. So our process and our policy is really simple. We take a loan application with an individual, and they've got to send us all their documents. And the reason it's to your point, Larry, is that I'll never put a pre-approval out there with my name on it that's not going to close. Right. There are unforeseen things that can happen, but it's not going to be because it was a lack of us verifying income, assets, or credit. We're doing all of that stuff up front. So number one, and that's part of the expectations. Part of our initial buyer consultation call is I'm having that conversation with you, Jaron, the buyer, saying, hey, here's what's going to happen. Yes, I'm going to ask you to do a little bit more work than the Wells Fargo guy who's having you do an online application, pulling your credit, and then saying, go shopping. So for us, we want to take it to another level. And I'll tell you, it's a little bit more work, but I'm going to personally get on the phone and call Larry, the listing agent, and let Larry know how much work we've done and how far we are, so that I can make sure that Larry can assure his client that, hey, this offer is much more solid than this other offer. One, it's a local company. There's accountability and locality, right? We're going to see each other all the time. And then number two, it's because we've done all of that work up front. So for me, that has been a huge decision. We made that decision a long time ago, and it's worked very, very well for us. Mm-hmm. With respect to the condos, Jared knows this stuff inside and out. But what I was telling Larry was essentially, we created a condo desk. And what we wanted, and we saw an opportunity because we realized so many condos were falling apart, and what would be a dead deal for, hey, this thing's falling apart. Can you save it? And we'd look at it and we're like, how did they mess this up? Or I'd look at it and say, they're telling you the condo denied it. This person doesn't income. It doesn't even come close to qualifying. So my issue that I have with our industry is that salespeople in general will tell you what you want to hear when they need you. And then they have no problem telling you something completely different when they're denying a loan because of the condo, when it was actually their income never qualified or something like that. So for the condo part, what we've decided to do is let's focus on this, because also from an affordability standpoint right now, like what we were talking about, some of the lower end price stuff is going to be condos. So we had to get really great. So why don't you tell them a little bit about the condo desk and how it works for us?
Yeah, I mean, you were mentioning it, Larry. A condo can be denied for a number of reasons. So every time I'm talking to a real estate agent or a borrower, and we start going down that condo path, I always try and take them on a little bit of a history lesson. I go, I'm sure you've heard of the Surfside building collapse, which happened, I think it's about 2.5 years ago now. And as an industry, we swung very, very hard to a direction where we needed to overly anticipate issues. And by overly anticipate, we're supposed to go as far as reading meeting minutes from the last 6 months of board meetings and determining from those meeting minutes if any upcoming assessments are going to happen. Now, sure, everybody here has sat on a condo board one time or another, other than me probably, because I try to avoid them like the plague. But I do go to my annual board meeting and live in the townhouse community, and I don't pay attention. And so who knows what's going on in those things, and who knows what's going on in the meeting minutes? I don't even think we take meeting minutes.
That's what I was going to say too.
Yeah.
I can't tell you, it's our protocol to get a year's worth of meeting minutes, which is unrealistic to start with, right? But we do it on every listing, and we go ask the condo board for these things, and they look at us like we're out of our mind. I mean, we get a list, and it's on the addendum for buyers that says they have a 3-day right of rescission if you don't provide them X, Y, and Z, and meeting minutes is right on there. And I don't like half these condo buildings, they won't provide them to you. They don't have them. They don't know what they're doing. They lost them, right? Whatever. They're in writing. They were written down.
But that is the greatest challenge. The greatest challenge of a condo is not the actual determining whether or not this should be something that we should lend on. The greatest challenge is actually collecting and gathering the data and the information from the associations, the management companies. That's where it is. The whole purpose behind the condo desk is that, for me, I want somebody who will call 3 times a day and email. And the only way to have that is to have an actual dedicated employee whose sole job is to do that. So that's why we built that out. It wasn't about the reading of the different instruments. It's literally the grunt work.
Getting
You
it.
know, get that
Persistence.
persistence.
Yeah,
Yes.
because of
Not giving up.
incompetence.
Yes.
You have that persistence because of their incompetence.
Well, the
Exactly.
property manager, in their mind, is not there to help us. Now, meanwhile, condo questionnaire fees, which our clients have to pay, have gotten astronomical. I mean, I've seen them high as $1,000 for them to answer some standard questions and give us these documents, which, you know, the seller should be able to get for free. They're part of the board. But, you know, person who mans our condo desk, Nico, he'll say to me, hey, this guy told me to stop emailing him and to stop following up. I'm like, that's a badge of honor, man. That's what we want to see.
Yeah.
Because to Emmanuel's point, that's the hardest part of this. Making a credit decision when you have everything in front of you rarely takes longer than an hour. I mean, it's just not the hard part of our business. It's getting the information needed
Gathering
for
information.
it. And so that's what our condo desk does. But to what we look at in a condo as lenders now, I mean, we're looking at the meeting minutes, we're looking at the budget, where in years past, if you were putting a big enough amount down, you didn't need to look at their financials. You need to look at everything the condo can provide and a lot of things they can't provide. You have to go on a fact-finding mission to try and make this determination, this very vague determination as to whether there's financial, structural stability and habitability, or there aren't issues in those places. You need to make sure they're properly insured, which
That's what I was just gonna bring up.
in Florida is a nightmare right now. You know, in order to,
We've had a building recently that was not insured properly, and
The edge.
it wasn't the edge.
Oh.
It might have been. I don't know which one it was. And it wasn't insured properly. And we've been working with them for 30 days to get them to get insured properly so they can get financing. So this buyer can get financing, because they started to realize no one can get financing in this community. And the president, fortunately, was like worried about this and cared. So
it makes no
lucky.
sense.
Yeah.
It literally makes no sense. And there, you know, like for me, this should be protocol. This should be really something that's really simple. The issue with, and on one hand, I sit on my board for my association in my residence, and I understand that we make decisions oftentimes that you think are in the best interest of your clients, consumers, whoever you're representing, homeowners in this case. And because insurance, you know, my community alone, insurance more than doubled in a year. Went from $125,000 to $280,000, something like that, right? And so because it's gotten so expensive, people are cutting corners and they're taking shortcuts. And so, for example, the reason I thought it was the edge, because I just had a transaction where a realtor called me up and said, "Hey, can you save this?" And I said, "Well, why is it dying?" And well, they increased their hurricane deductible to 10%. I said, "Well, no, that's not allowed. I can't, you know, like they can't do that." "Oh, well, they did that because, you know, the premium was going to go too high or whatever it is." So sometimes they're making financial decisions, but meanwhile, you know, if I'm a homeowner and I realize that you didn't increase my dues by $100 a month because you didn't want to pay the increase in insurance, but you just negated my ability to sell to 60%, 70% of the potential buyers because now we can't finance that property. You know,
Well, now the value of your property
the value just
dropped,
went down. And you
maybe
ju- you know,
10, 20%.
Exactly.
Yeah.
So
Yeah.
it's some of it is just people just don't think.
It's logical.
nobody's explaining it to them. You know, obviously the insurance agents aren't. The easiest thing, going back to purchase price of a property, is the only thing you're looking at on that insurance policy is that price, right? And I've talked to enough building, not necessarily the property manager, they usually know what's going on, but the HOA president. You say, "Hey, you guys changed insurance. Oh yeah, we needed to do this for, you know, what they thought was a smart financial decision." I go, "You know, your building is not properly insured. If you look at your appraisal, it's at 50 million. You know, these big buildings cost a lot of money. You're insured for 30 million. Well, what does that mean? That means you guys need to cough up 20 million if a hurricane comes and knocks this building out." And they're floored every time. Oh, and by the way, until then, your property values suck because nobody can buy it. You're in a price point that's going to demand probably higher than 60 or 70% financing buyers. It's probably 90 to 100% financing buyers in these price points, especially in South Florida. And they just don't get it. And, you know, it's a sad thing that we see really often, especially when, you know, we get called to save these deals. They shouldn't have been deals to begin with, which is another kind of aspect to the condo desk and aspect to, you know, our process here is we try and gather as much information upfront as possible. We have a quick 7 questionnaire that we try and pass on to listing agents. Most of them aren't as proactive as you, and they won't know the answers to these. But a lot of these questions can be found out by, or a lot of these answers rather, can be just be found out by asking really open-ended questions like, hey, have your dues gone up? Has there been any insurance talk? Have you seen repair crews around there? Do your balconies work? Just things that you as an informed agent, as an informed buyer should be asking. And we encourage that. We encourage our loan officers to talk to their agents about it. We encourage our buyers to talk about it prior to putting in an offer. And you can find out a lot upfront by just asking those general human questions.
I thought of a business idea. We should create a consulting company that allows all these HOAs to consult us during their budget process.
Oh, yeah, they're going to pay more. That's what they want.
Yeah.
Another cost.
Hey,
If it's free.
But it's not. I mean, if you can't finance your properties because of it, but yeah, it's just a lack of knowledge.
That is crazy. Yeah, but Larry, do you have other questions of Emmanuel and Jerry?
Where do you guys, you kind of mentioned, you kind of alluded to where you wanted to take the business. What's the next step for you guys here?
Well, in the immediate run, obviously it's to stay alive. I mean, it's not like the business is in general that, the entire industry, most mortgage companies are not making money. Most mortgage companies are floating by. Luckily, we made our hard decisions, I don't know, I guess it was at some point last year. And when we cut some of our workforce down. But that part of it is my job, and part of it is my job is to go out there and to find unique venues. We've partnered with some builders since last year. I've got a new listing agent concept that I'm, we're working with, and we're trying to go out there and find different revenue sources and find different avenues to do business. We're expanding our cup size, so to speak, and that's why we're heavily recruiting, and we didn't even start recruiting until March, and so that's going really well for us, and so we're excited to expand upon all of that. At the end of the day, we can't control where rates are, and it's going to be the rates are the same for everybody else. So you just got to roll your sleeves up and go to work, and we've got to work twice as hard to make less money than we did in the past, but that's okay. We're going to be there, and there's a stat. I think the numbers are. Within a 1 year period, or from 2021, there was about 171,000 loan officers nationally. And they say by the end of this year, we should be around 70,000. So there's been that much of a decline in loan officers.
60% attrition, more or less.
Which sounds doom and gloom, but no. Like, what an amazing opportunity. There's so many people that are going to be exiting the business. So we came up with a concept called loanuity, which is essentially I like retiring loan officers. Basically what we do is they hang their license with us. They don't have to do any of the work. We pay them for their database. Let their database work. We'll work the database, partner them with one of our loan officers. So that's a cool, unique strategy in order to let people retire but make money. Mm-hmm. And because that was obviously, there's a need. So it's just about getting creative, finding different things that we can do that will generate revenue for us.
It's great.
That's interesting. So obviously refis are basically gone, right? You're not doing refis. And was that a big bulk of the business before or no?
So for us, I don't, Jared can answer our specific numbers. For me, I'd say I was probably a 60-40 purchase refi. So I did do quite a bit. We market to our database quite a bit. So we've got a really high repeat and refinance business. And you'd be surprised. Refinances aren't all gone. They're starting to come back. Student loans just came, people started having to pay them in October. Credit card debt is in 25% interest rates. The cost of living, and as the reason things are about to shift is that although we have been in a recession for quite some time, the rest of the economy is starting to catch up on that recession. And as that happens, people get a little bit desperate, but they still have a tremendous amount of equity in their homes. So people are going to be forced to tap into that equity in order to pay these bills, to pay off this debt. I take loan applications. Somebody has $50,000, $60,000 in credit card debt. Like, who cares if your rate is 3%? Like, my 7% will still, consolidating all of this debt will still save you $2,000 of minimum payments. You know, compared to 25%, you kidding? And plus, we're amortizing this over
Yeah.
30 years. So, you know, you can still save a lot of money. So refinances are right around the corner from really picking up.